All right, everyone. Hello, I am Joe Krolichak. I'm with Century 21 Morrison Realty in Bismarck. You are joining me tonight for a deep dive into the real estate market for April and a forecast into the rest of the year. Hopefully, you are having luck in signing in, checking me out. I am on my page at Bismarck Mandan Properties. And I'm just going to kind of hold on a little bit and hopefully people will be joining me. So hang tight, guys. We will be signing in shortly. All right, we will be starting here soon. Thanks for your patience. I will try to answer comments as we kind of go through here. I've got my phone looking at everything, and if I don't answer you right away, I will be sure to answer you at least right after the seminar. All right. So we are just going to dig right in. We are going to talk about all that's happening in the United States residential real estate market so that you can be an informed home buyer or seller. I want to hop right in. We got a lot of things to cover. I'm going to share my screen here, and we're going to start off with a snapshot of the market year over year. Oh, technical difficulty. Oh, okay. Sorry about that. So look at the snapshot year over year. Metrics we can see showings are up 49.5% year over year. A lot of people are getting out there and wanting to look at homes across the country. Purchase applications are up 39%. So we're in a really interesting period right now. We're going to start to see some of these metrics shoot up year over year because what we're measuring right now are the weeks when we first started the lockdown last year. So seeing significantly more purchase applications because nobody was applying or leaving their house for that matter. If we look at the pending deals, this is actually measuring February. Those down just slightly, but existing home sales and new home sales both up, knocking at the door of almost 10%. You know, where is the issue, right? The issue is in inventory. We know across the country it's something that continues to plague us as an industry, but overall, if we look at some of the other metrics year over year, a very strong market as we head into the spring right now here in April. The other big thing that's been going on in real estate is we're seeing a rise in interest rates. The average 30-year fixed as recorded by Freddie Mac at 3.18% right now. To put that into perspective, we saw towards the end of the year dipping down into the middle twos. This puts us back somewhere around June of last year, where we saw this rate environment start to slide down to the twos. Historically low interest rates. We talked about this 16 times last year, a new low in the average 30-year fixed. And it's starting to come back up and really seeing the return of those rates creeping a little bit higher as the economy improves across the country. The reality is, and I think George Ratu sums it up very well, he says, home sellers and home buyers technical issues. Home sellers and home buyers have gotten really used to extremely low rates. Rates, even in the 3 to 3.4% range, remain extremely affordable by historical standards. We've been talking about the rates are going to continue to rise as the economy improves. I do expect in the coming month that we will get estimates and forecasts for what experts are saying the remainder of this year will be for the rate environment. And I think some of those are going to be upticked. We've seen Goldman Sachs say as high as, and they're looking at the 10-year treasury, saying that we could be at 3.75 by the end of the year. Some are saying more at the lower end of that 3.25. What do we know? It's going to be at 3.75. We really don't know. It's probably not going to be where it's at today, and we'll continue to see interest rates rise as we go throughout the year and the economy improves. All this low rates, folks running in to buy homes has caused the inventory challenge across the country. This is a snapshot of the new listings coming into the market as compared to the total listings in the country. Right now, across the country, on average, we're down about 52% year over year in the number of homes that are available on the market for those who want to buy them. Seeing listings coming to market and certainly want to see that continue to grow as we move into a strong spring market and more people are putting their homes on the market. But right now it's a deficient across the country. If we look at this map, we can see the majority of the countries is in this red, and there are states in the dark red at 60+% down year over year. No doubt that low interest rates, no doubt that the pandemic, no doubt that other pressures around housing have caused this issue of low inventory. Experts are forecasting inventory to come back into the market the second half of the year and more as people get more comfortable. Those are affected by the pandemic economically and having to list their homes, builders building. But as we stand right now, the inventory situation across the country is pretty dramatic in lack of homes for sale. Dr. Lynn Fisher from the Federal Housing Finance Agency. House prices nationwide recorded the largest annual and quarterly increase in the history of the FHFA Home Price Index. This low inventory is causing prices to spike up. She accounts it to what we just said, low mortgage rates. We've seen that. Pent-up demand from home buyers and a limited housing supply propelled every region of the country to experience faster growth in 2020 compared to a year ago, despite the pandemic. Oh, I'd like to go back, but I may not be able to. Back a year ago, John Burns Consulting, who we follow and you're probably familiar with, because that's where I get a lot of the information that I use, predicted the great American move, that folks would move from their homes for financial reasons, for health or security reasons, or just in need of something else in their home. And that certainly has happened as we went through 2020 and now into 2021, and it has caused this price increase. One of the questions that I am constantly looking at are what are some of the causes and effects of some of the situations we found in the housing market? No doubt this lack of inventory has both been caused by a number of factors. One's very interesting here that I want to share with you, and something I would encourage you to share with others is that single family housing units that have been completed for the last 13 years, they've been below the 50-year average. Now, if we go back in time, you see the red bars in the middle of the screen here. That's all 4, 5, and 6. Because of the record-setting times in our business, 4 consecutive years of record-setting number of units built. There were 3 years in this country when more than 1.5 million homes were built in 4, 5, and 6. There are 3 years in this country where more than 1.5 million homes, never happened before, never happened again. And what we know is that the housing crisis is builders were very much at the center of real estate, and construction lending dried up. A lot of lending. The pendulum swung on that. Following that time, builders have not been bringing to market the number of units to keep up with population growth. If you look back in the 70s and the 80s, more homes were built in this country than they are even today. And this image here simply and effectively conveys the message to everyone that we're in a deficit, because literally the number of new units coming to market has not been there. Now, builders are building, permits are up right now. They're concerned, obviously, about rising costs in the new home market. But what we need is more builders to build more homes to get folks what they want, to own a home and to give them the opportunity to do that. Softwood lumber is up year over year 112% due to pent up demand, remodeling increases, and a lack of lumber inventory. Some of the big things that are bearing in on our market right now relative to low inventory prices rising. One of the questions that's come up over and over, and I want to address this here because I think it's really coming up in a lot of different places. Are we seeing this cash out refinance issue? So I've clipped a couple of headlines. House or ATM, cash out refis surged to their highest level since the financial crisis. It's all leading to this question: are we seeing a cash out refinance crisis in this country? Is it something we want to take a look at and say, okay, what's true about that? What's not true about that? First, let's look at this. Home equity cashed out by refinances in the billions. I've isolated this past year in 2020 to the highest year in six. 153 billion last year cashed out as cash out refinances in this country. Back then, at the height of the market, 321 billion cashed out. Nowhere near what it was back then, but yes, at the highest levels since the crash. And so that part is true, but in context, you have to understand where it was back then, and we're nowhere near where it was back then relative to the amount of cash out refinances being transacted across the country. What this has caused is the amount of tappable equity that US mortgage holders have has caused it to surge. The tappable equity is defined as the amount available for a homeowner to access before hitting a maximum 80% combined loan to value. So if you own a $100,000 home, if you own a $100,000 home and you owe 80,000 on it, that's 80% loan to value. And what do we know? LTV, inequity in homes, is surging right now due to the way folks have handled their equity over the last 10 years and not accessing it. Back then, tappable equity was knocking at the door of 5 trillion, and where that stands today is over 7. And so this is something we want to continue to look at and continue to monitor this relative to the cash out refinances. Equity and tappable equity is surging in this country. As we look at this, cash out refinances in 2020 were nothing like six. That's where these questions come in. Okay, is it like back then? I mentioned tappable equity because they're on the left side. Back then, 4.6 trillion in tappable equity in homes across the country, whereas today, the year we've just finished up, 7 trillion in tappable equity back in six. 89% of transactions were cash out refinances. Why is that? Well, we're in an upward trending interest rate environment back in six in the first half of the year. So nobody's going to be financing there to get a better deal for the most part. And where do we see it today? We have been in a downward trending interest rate environment for the last year. 33% of refinances were cash out refinances. The total cashed out, like we mentioned, 325 billion back then, 153 billion today in 2020, representing 7% of the tappable equity back then, where today it's only at 2%. So very, very different today versus back then. I know home prices are rising. What are people doing with that equity? Are they accessing it? Are they misusing equity like back in the housing crisis? The Wall Street Journal came out and said this: the residential real estate market is on its biggest tear since 2006, just before the housing bubble burst and set off a global recession. Yet in nearly every meaningful way, today's market is the inverse of the previous boom. In the mid 2000s, loose mortgage lending standards enabled borrowers with poor credit histories to purchase homes beyond their means, sometimes with mortgages that required low down payments in the early years of the loan. And they go on to talk about how that froze up the credit markets across the country. And what do we know? We know that today lending standards have dramatically changed. We know that in order to go and obtain financing for a home loan, you've got to qualify for financing of a home loan and you have got to demonstrate the ability to repay. It's very, very different. No doubt the market that we're in is showing tremendous demand for homes across the country. NAR, National Association of Realtors, came out and said this: speaking of demand, with demand for homes outpacing new listings, buyer competition continues to intensify. On average, there are 4 offers per home sold of a closed home in February, according to NAR's latest February Realtor Confidence Index report, a monthly survey of realtors about their transactions. A year ago, there were 2 to 3 buyers every home sold. The intense competition has led to double-digit price growth and properties selling in record time. To get back to a healthy supply equivalent of 6 months of monthly demand, an additional, uh, an additional, uh, um, let's see, I am going to the next additional healthy supply equivalent to 6 months of monthly demand. An additional 2.7 homes should be on the market for sale. So let's break down the comparison of the two markets, maybe the time leading up to 2006, the time today, and give you a look at that so that you can be educated on the differences in the two markets. First, let's look at annual home price appreciation. No doubt we've seen home price appreciation be significant. In the last year, 2020, according to CoreLogic, 9.2% appreciation. But if we start to compare the years surrounding the lead up to 2006, the lead up to today, back then, the average annual appreciation was over 10%. Just the average from 2002 to 2005. And today, 2017 to 2019, the average 6.3% in annual appreciation. Big difference there. Certainly, we're seeing approbation based on the lack of supply, and I am going to talk about supply back then in just a moment. So the question is, people are out there and demand is strong. What does that mean for those that are buying homes? This graphic shows the default risk in the mortgage markets. Oops. Sorry, guys. It shows a default risk in the mortgage markets. A very good visual to talk about where our lending standards today as compared to back then. This yellow line, the reasonable, what I'm going to call the reasonable lending standard there, a little bit of product risk, a lot of borrower risk than if you look at the graphic there on 2005 and 6, where today product risk has been basically eliminated from our business. The loan products that were in the market back then are not around today. Borrower risk has been severely cut back as to where it was back then as well. It's harder to qualify for a home loan. When we look at demand, we can say back then demand was inflated, whereas today demand is real as measured by those in their ability to qualify for a home loan. Back then, another interesting comparison, single family inventory was up in 4, 5, 6, and 7, and prices were going up. Whereas today's inventory has been going down and prices are going up. So when we look at economics, the amount of any item for sale as it goes down, there is less of it. It's going to drive the price higher. So we're dealing with dynamics in the market back then. As the number of items in the market were rising, homes, the price was also rising, very much defined what we would be, say would be the economic fundamentals in the real estate market. Whereas today we can say, okay, the reason for the price growth, going back to Lynn Fisher's comment, has been in large part by an extreme demand for some very real reasons: low interest rate, the pandemic, the lack of homes, And it starts to make a little more sense. Odita Kushi says this. She says, it's not just a seller's market, it's a super seller's market. This is an increasingly competitive home buying environment and it is true across the country. As we look across those who are in the market that are homeowners right now, what that means for them as prices rise, home equity across the country skyrocketed. The average gain in a mortgage home over the last year has been 26,300. This number here is one that we need to get out there. The current average equity of a mortgage home is 204,000 across the country. 38.2% of homes are owned free and clear, and 16.2% is increased in equity, totaling over 1.5 trillion. Equity surging across the country, and as we go throughout the year, expect folks to say, okay, do we want to leverage that equity to move up, or do we want to do something else with our housing? In helping people understand just how much equity they have in their home, something will probably surprise them. Many may not know that they have that much equity in their home. If you look across the map here, states across the country are seeing significant gain in home equity. This is over the past year. We mentioned the average in the US, 26,300. California, that's 55,000. Take somewhere on the East Coast, North Carolina, 21,000. Significant numbers, depending on where you're looking at and where you're at across the country. That's really the message that we, truly want to get out here. There's so many things we could talk about in our business. I found a story from Mark Fleming at First American that I want to share with you. It gives a great analogy that you can use to be able to deliver the reality of the market with low inventory. We are selling a lot of homes. The market's very good, but inventory remains low. And it goes like this. Imagine a situation where I'm trying to fill up a bathtub with water, but the drain is open, the faucet is on. Think of the faucet being the flow of sales. Those are the listings into the bathtub. And the drain at the bottom is the sales that have been closed and are sort of going out the drain. At any point in time, the amount of water left in your bathtub is your current inventory. So we've got this bathtub, sales are coming in, sales are going out, and we measure it once a month, and that is inventory. He goes on to say, so what happens in the housing market? We've got the faucet open at the top and we've got the drain open at the bottom, and once a month we measure how much water is in the bathtub. Now keep this analogy going. The less open the drain is at the bottom, the more flow in the top, and the more inventory or water is left in the tub at that measurement point. Turn it the other way around. If the flow in the top is slower, but the drain is wide open, the level goes down and there's less inventory. So these are the dynamics at play. The inventory measure as measured today only measures at one point in time. Got a lot moving through the bathtub, but we're measuring at one point in time. But what's missing is a whole pile of water that might have come into the bathtub and out the drain before you even knew it. So there we look at measures like days on market or how fast or how the velocity of the markets are. And what's happening today on our market is the average days on market is 21 days. And a lot of homes are flowing into the top of the bathtub and flowing out the other side before we can even get a chance to measure them as part of the inventory. As we deal with this low inventory situation, I'm not saying it's an issue across the country. It really pretty much is, but we're selling a lot of homes. A lot of homes are moving through the bathtub. And using Mark's analogy, I would like to give you something to use so that you can make the best real estate decisions as you talk to others about the dynamics that are happening in the market today. These are my resources. I'm happy to share any of these resources with you. Just let me know. I can email them to you. Thanks for joining me, and I look forward to helping you make smart real estate decisions. As always, I am reachable by phone 701-391-2127. My name is Joellen Krolichek. I'm with Century 21 Morrison in Bismarck, and I look forward to helping you. Thank you.